seed investing is systemically broken today. There's just as much capital chasing fewer and fewer folks that can grow at triple-digit rates. The best investments go 1 to 10 million in 5 quarters or less, the very best ones. The one you can't IPO unless you triple, double. As you approach 10% market share in your core ICP, your core market, you got to expand. If the churn is anything more than 3 or 4% a month, it's not even software anymore.
Ready to go? Jason, I always love our chats. This is such a joy to do, and our shows always do so well. I always get notes from founders being like, whenever Jason's on, I literally get pen and paper out, and these are the ones that I have to listen to. So I'm so glad to have you back, man.
It's very, very exciting, Harry. So great to be here, and so proud of everything that's happened with 20 VC Empire. It's great to have been there on the sidelines since being guest number 50.
Dude, I remember when I was at university and you were like, should we do the SaaStr podcast? And I was like, yeah, this is great. I mean, you had that, I don't know if you still have it, but you had that like picture of you, was it in a helicopter with the like,
oh yeah, that one. Yes.
That one, I thought that was so cool as an 18-year-old, but I want to dive in. This is a new type of show. So I'm calling it 20 VC, the review, which is like analyzing the best and maybe the less well-performing deals, or worst in other words, and then highlighting, hey, lessons and the story behind them. If we start on the best, Jason, what is the best deal that you've done? And what did you learn?
Yeah, I'll answer that, but I made 2 best lists for you. One was the best by cash back, which we all thought was no big deal in 2021, but the last couple of years, cash has looked scarce. It's looked 2 IPOs in B2B in 2.5 years. And by NAV, which is what we report to our LPs on paper, what are the best 3? And so far for me, I'm 10 years in. I had a little bit of a break for a year, right? Maybe I should have invested faster. But what's interesting is, and I'll answer your question, my best by cash and best by NAV are not, there's no overlap yet. Maybe hopefully in 3 to 4 years, they will flip. And the ones that on paper are worth the most will become the most in cash. But the best 3 for cash I've done, and we can take the conversation we want. The number 1 was Salesloft, which was the last big deal of the 2021 era. It closed, I think, December 23rd, 2021. HashiCorp was the last IPO, and Salesloft sold for $2.5 billion of cash at about $100 million in ARR. The second one was Pipedrive, which I don't know what that one would be worth today. That was $1.5 billion in cash as well. And the third one, ironically, was smaller, Harry, which was a company that got sold Logical for $300 million, but I learned a lot from being multiple times the largest investor, because we all brag on Twitter and X how we were early and this and that. But if you own 0.1% in a fund, it's not going to get you that far, is it?
How much did you own of Logical when it was bought?
I mean, all the entities own 20 some odd percent, and it's cash. So that gets you a good, it's a distant number 3 on the list. But for me at this career, it still gets you a material return, right?
Yeah, totally. That's a good 60 million.
And dilution. I'm learning a lot. It's taken me a decade to understand what folks have been doing it a little bit longer say about dilution. It also helped that they stopped fundraising.
Would you have predicted those companies would be the 3 top cash returners?
No, I didn't. That's interesting. The NAV ones I predicted 2 out of the 3. The cash ones, it's funny because VCs always, they say some variant of like, you got to go long. You don't know how they'll perform, at the end of later in life. And I don't really believe that. But when I put this list together, I realized it's true. I didn't think any of these things would happen. Salesloft with Kyle, he was one of the most determined founders I ever met in the early days, right? And it was a fun one for me because I co-led the seed, but then I brought in emergence and insight. And so almost the whole cap table I was able to kind of assemble, which is harder to do today, but it was fun then. There's certain founders they can't lose. They can't lose, right? But sometimes you just don't know where the hell it's going to go. And Kyle never quit, but right after we invested, they had an $8 million product they dumped. So it went from 8 to almost $0 million in revenue. And it was totally the right idea. Like, no, today in my career, actually it would startle me more than it did back then. Back then it was early. I'm like, that's cool, man. Like, okay, if that's the right decision. I mean, I challenged him on it, but he was right. But to go through so many things, to expand the platform, to go more enterprise. I had not been in, now it's very common, but back then, they and Outreach were so competitive. I didn't think both could win. I didn't think both could even survive. This wasn't my life experience in SaaS. Like, it was more like only one could capture that 60 to 80% market share VCs always talk about. I didn't think you could have two folks with 40% market share. I didn't think it was possible.
So what did you learn from that investment? When you look back at it going in the early days from 8 to 0, the bumps, the highs, what are the takeaways?
The number one thing is, and this is, when I look at my three worst ones, this is going to be the theme of the three worst ones, is just, it's not enough, Harry, but that ultra insane commitment to success is so important. And then having a binary team. So what Salesloft didn't have, Salesloft's chief product officer, this guy, Rob Foreman, they were the pair, the binary pair. And sometimes it's more the CTO and the CO, sometimes not. But if you have a binary pair that is 110% committed and they can build pretty decent software and sell, that's rare to have both, right? And and so those are the magic. The other thing though that is, the thing that has changed radically, things are move so much faster today. So in the old days, so I met Kyle, who was the CEO of Salesloft very early, but then I started hanging around the offices of a lot of startups, and their first product, like every sales team was using their first product. Like, you used to get to spend a couple of months watching something in the field, making a decision. Now you got to pay 25 pre a demo day in 1 hour, right? So the world has changed. So in a way, like some of these early deals that that VCs brag about, it was a different world. And there are some different worlds of time, right? Of literally getting months in some cases to make a decision. But finding what I will never sacrifice again is two great co-founders, and not for great numbers are great, but insane level commitment, like commitment better than me. Like, you're even more committed than me, I think, Harry. And I'm a pretty committed guy. So anything less than that, Harry, or just don't, as an investor, this takes too long now. We're like 14 years to IPO. People are quitting left and right. They're quitting left and right, or they're quiet quitting, or they're settling in for 5% growth, right? It's just not worth it as you can't make any money in VC, can you?
You absolutely can't.
It's impossible.
Can I ask, given the changing times, how does that impact how you invest today?
I don't know. I'm still learning. I think that it's harder if you have less time to get to know people. It's harder to catch the cynics. It's harder to catch the bullshit artists. But the main thing I just do is I almost immediately do another Zoom with the CTO. That's actually the way it's changed. In the old days, I would do it late in the process. I would get to know the CEO, would talk to the customers, right? I would go deep. And then at the very end, I'd be like, okay, I got to talk to your CTO, Harry, to make sure that this is real. Now, I immediately skip everything else. And at the second call I want to have is with the CTO. That's how it's changed for me.
What do you want to dig in on with the CTO?
Well, one thing, you've done a lot that already, Harry, in your career that I haven't, but I have built software that's done hundreds of millions in revenue. And I've created an industry and rebuilt a product. So one thing I do know is the difference between great and good software. Okay. And so I can talk with this, and I know the best CTOs. I know someone that is better than the best CTO. So I want to know, is the CTO are they a 10 or a 5 on our old logarithm scale? Are they amazing? Can they build software faster than anyone else in their competitive industry, better software more quickly? And it's so easy when you talk to the best CTOs to hear it and learn it. It takes 7 minutes.
What do those great CTOs show you in those 7 minutes that distinguish them as world-class versus the 5 or 6s out of 10s?
Well, first, I do give them an hour, not 7 minutes, right? But what do? First, I ask them to do their own demo. Even if the CEO did the demo, I want to see how they think about their product and what they're excited about. I want to see surprise and delight. I want to see them show me the things they love. I want to show me, listen, this is this badass thing I just did with AI that, OpenAI can't even do this. Let me show you, Harry. Like these guys at Anthropic, they don't even know how to do this, right? This is so cool. Let me show you something I know how to do that the rest of the world doesn't even know how to do yet. That's magical.
Do you say, show me your surprise and delight moment? How do you
No, I don't even have to do that. The best ones are so proud of their product, their code, their work. They'll show you in the demo. They can't help themselves. I'm just like, okay, show them what's your favorite feature? What do you like? What are you most excited about? And what frustrates you the most in the product? They can show you why they're bothered and why, I can't afford it. And the Open AI API is too expensive, or this is broken, or the Stripe API doesn't do what I want. And you just want to hear this magical insight, right? And just get them going from there. Have them show you, and they'll show you what they're proud of. The best ones, they'll show you what's badass. And the really good ones, just like the best CEOs are asking them about competition is so telling. Asking the CTO what frustrates them in their product is very telling. The great CTOs will answer in 60 seconds. I'm just super frustrated that I can't get this next thing out on the API, or this next workflow out. I'm really frustrated that we're behind on our webhook platform. Whatever it is, they'll tell you instantly. And the mediocre CTOs will be like, it's pretty good. Let me straighten my tie and get my blazer in the right order. And I'm off to another meetup. Everything's great.
Do you find that they do reveal their frustrations, given the fact you're an investor and you could be writing them a large check?
I have never met a great CTO that isn't at the edge of hyper transparent. Never met one. If I did, I would run for the door. The best CTOs, that's the environment they're in. They're challenging everybody. They surround themselves with people better than them, engineers better than them. And there's a couple secrets they're going to hide some secrets, right? Don't get me wrong. There's 2 or 3 secrets a CTO might hide, but they're so technical, I can't understand them. They're not going to hide anything that someone can't figure out playing with your product for 2 hours. Why would you hide something that your competition can figure out? Because your competition's using your product, aren't they? They sure better be. So, and your competition can actually pretty much expose anything that you can see in the browser. There's only so much you can hide, right? You can find out your stack, anything you can expose in the browser and what the product does. So you've got to be a pretty weak CTO to hide that stuff, right?
Yeah, totally do. God, dude, I'm loving this. I'm also just terrified.
This is my so I skip I used to do the CTO like 2 or 3 weeks into an investment. Now it's literally, can I talk to Jane tomorrow? Can I talk to her tomorrow? I don't even need to do all the rest. I need this binary pair.
Okay, what % of the time is the CEO great and the CTO and what do you do in that situation?
Overall, I would say 80% of the time, the CEO is better than the CTO, especially at the seed or early seed stage, because there's different ways to like get up 10 customers and 20 customers. And the real reason is, almost at least in B2B, almost every startup that gets to like $1 million, like we're talking about, they have what I call a 10X feature. There's something they do better than everybody else. Like most of the product sucks, right? Because they've only been around 18 months and they haven't been doing it for 10 years, but they do something that the leader doesn't do well or at all, right? And so the fact that it's a 10X feature sometimes can mask the fact that the software is not that good, right? Especially if you get into more vertical SaaS or areas with more bounded competition. And those ones tend to get swamped as you scale. The growth decelerates at 10 or 20 million as like a cool 10X feature, but not the ability to iterate faster than the competition. The competition swamps you 3 to 4 years down the road. So I don't know if that answers the question, but so up until $1 million or 2 million, a 10X feature plus a CEO can win. And sometimes that CTO is okay or not that committed or might quit or whatever. And that 10X feature never becomes a 10X platform.
But will you still invest if the CTOs?
No, because listen, this took us a while to figure out, Harry, like, we can't even make money on $1 billion exit unless you own 20 something million, like Logical. If you like dilution's so high as a seed investor, let's put aside an opportunity fund or SPVs or other things. Let's take a traditional seed fund. Okay. Really, in today's world, you're going to suffer 50% dilution on the way to IPO. That core seed fund that you struggled to get 12% of, it could be 6 by the IPO. 6% of $1 billion M&A is only 60 million. So this is where it's funny. I'm coming around after 11 years of investing, Harry. I'm coming around. When I started, I didn't believe you could make money in venture. Even though my first 5 investments all worth $1 billion or more for real billions. I didn't believe it. I believed that they could each do 5X, okay, which I thought was enough, but I didn't believe the funds could make money. Then we go into 2018, 2010, and I start to believe, hey, these funds can make money. And then 2021, I'm like, this is easy. Now I'm kind of in a mode now where I'm like, I got some decent investments, but it's hard to make money in venture again, right? So you got to have $2-3 billion exits, especially if you've had some success in this world. If you want to make a little bit of money and drive a whatever, a Mercedes with your fees and enjoy the high life. Yeah, there's a lot of ways to make money in venture, but if you want to make 100 million or more, there's only a handful of ways to do it.
There absolutely is. I do just want to go back to this process because I'm loving this. Okay, so we have those CTO interviews as part of the process. Do you meet other parts of the exec team? Will you spend time with the head of sales, head of CS, or is it founder?
I used to. I remember the very, very first investment I ever wanted to make. I had known the founder from the old days, right? And it was one of these ones that when you start investing, you want to do. They were like, even though I was doing seed, they were like at 3 million, growing pretty quickly, not burning a lot. It seemed like low risk kind of investment. Sometimes when you start, you want to do it. And I go up to San Francisco to the office. And the first time I sit down with the VP of sales, I'm like, how are sales going? He's like, actually, this is my first time I've ever done sales. I've traditionally done product. I'm new to sales. The last 2 sales folks quit. Like, okay, that's a good sign. He's like, how's the pipeline? He's like, terrible. So I quickly learned to interview the whole management team. Having said that, fast forward to a few more investments in, even though I want to do late seed, which I think is what you would prefer. That's maybe where the overlap of our investment styles. These days, they don't have a management team. So I don't care anymore. I just care about the CEO and the CTO. And me, the CTO is great and the CEO is great. I really don't care if the one sales guy they have is good or if the marketer they have that just does clips is great. I used to care from that story, but if I'm investing in someone with 10 employees or less, I don't care anymore what the management is, but I do care what the CTO is the one I care about. That's just me. That's my changes over time.
Just one final thing on that. Will it take me a while to build a benchmark of what great CTOs look like? Or will I quickly be able to tell, do you think?
I think it may take you 20 of these Zooms to learn. I didn't know. There's a guy named Chris Dean who now runs a banking as a service platform called Treasury Prime, a YC company that I invested in. They started in our old offices, actually. And in the old days, when we were at our first startup together, we were young and new. We actually got acquired for, on paper, $1 billion, my first startup. And when they acquired us, they made him their VP of engineering. The acquirer made Chris their VP of engineering. I'm like, okay, I don't know much, but I know he's got to be pretty good if you acquire a company in a different city and you make their number 2 guy your VP of engineering. So I stuck with him. He interviewed all of my original engineers and executives back at the early Adobe and EchoSign day. We still stay in touch. And so I had a bar. I was lucky that I had a bar from him, right? And we triangulated. So I skipped some steps, but when you interview 20 and you see the lights go on and the magic and them show you the demo and show you how they built it and you just listen. And the other key is if you haven't built the software before, Harry, just ask Columbo style questions. Just ask open-ended questions. I mean, you're good at you've done 1,384 podcasts, so you're pretty good at the open-ended questions. Just ask those basic questions. Show me a demo. What do you love? And then the other great question, take it 20 years, just what are the couple of gaps? What are the top feature gaps? This is the next question I ask. What are the top few feature gaps you have? Just ask, what are the feature gaps? Well, if they tell you none, you got a pretty crummy CTO. If they're like, Toast has this and whoever has this and we got to do this and our POS is terrible and I've got to integrate this, you just want to hear that. You'll see the same magic you see in any executive once you've done 15 or 20, and you'll see it tomorrow to start. You'll see it tomorrow to start. Don't lower the bar. That's the mistake so many founders make when they go out to interview a functional area they've never done before. I've never hired a VP of Eng or sales or marketing. They get excited that they worked somewhere great, that they worked at Datadog. Throw it out and just listen. You've interviewed almost 2,000 folks, Harry. And when you talk to the best of anything that's great, the best plastic bag manufacturer, the best mug manufacturer, they're the best. And it's the same is going to be true with the CTO. Just let them delight you, right? Let them show you. And you just want your jaw to drop 10 minutes in. You're like, wow. And the other thing related to that, I'll give you the last tip is this took me a while to figure out, even though it's obviously true, is yes, even by demo days, certainly by $1 million in revenue, the best CTOs have built great software. So I'm looking for signs of crappiness. I'm looking for corners cut. I'm looking for software that's too slow at $1 million in revenue. If the dashboards take 20 seconds to resolve at $1 million in revenue, what's going to happen when you have 10,000 times more customers? If it breaks during the demo, if things don't work, anything. And I know people kind of light me up and I actually kind of got hazed on Hacker News the other day for this on the business side. But when I see these signs that the software isn't good at $1 million, it rarely gets better at 10. It gets worse The load goes up, the workflows go up. So I'm not expecting this to be jaw dropping, but I'm looking for one little bit of beauty. And if that's broken or has tons of issues, I'm just out, right? Slow. I'm definitely out for slow.
Final one on Salesloft, but you mentioned that outreach as well. I'm just really interested. You also mentioned Opus before when we were chatting. I hate investing in competitive markets. I really hate it. How do you feel about investing in competitive markets, given those two, which are intensely competitive markets?
Yeah, I hate it too for the reasons I think you hate it, but two things. First of all, I believe, and I know probably 90% of investors either don't believe this or say differently. I believe the best opportunities find you at the end of the day. It's not that you don't find them, okay? But they also find you by the same token. And if you're going to pass on an amazing binary set of founders, an amazing CEO, CTO, just because they're in a competitive space, you're going to lose. You're going to lose the Ripplings and the Gustos and the deals and the data. You're going to lose Datadog because you're going to say, New Relic owns the market. You're going to lose these deals, even though there's some logic to it, right? So that's my first thing. Deals yes, at the margin, I'm out, okay? And we just talked about a sales productivity tool you invested in with jaw-dropping numbers, okay? I'm out on that whole category because there's 200 vendors, but that's probably an error. You invested in a great company. See, so I'm with you. I don't even want to take those meetings because there's too many vendors, but if you meet the bind, you just got to take them where you find them. That's one. And secondly, and this is just annoying VC math, but it's true, big markets often, not always, but often have more competitors. If you get too obsessed with having one competitor, you can end up investing in something that's just a small market. It's not always the case for sure, right? But you got to be careful you don't take that too far, right? It's just you got to bet. And then the last point is, and this took me a few years to see, even though I knew this was true from the beginning of investing, for hyper agile teams, if you have the best engineering product team in the industry, having a lot of competitors is a positive because they help grow a large market, and each quarter you pull away. Each quarter you pull away, right? Each quarter you pull away, and it becomes a net positive that everyone's investing so much money to educate the market, to grow the market. But if 4 years down the road, your product is 40 times better than theirs are, you pull away. So it's complicated, right? But I don't think it's as simple as running from competition. When I've done that, I kind of regret it, right? I kind of regret it a little bit. And the other thing that happens if you run from competition, especially sometimes in vertical SaaS, because you can find a lot of categories in vertical SaaS where the competition is SAP or Excel or paper or like some DOS application from the 50s or something like that. There's plenty of good ones there today, but sometimes those hide a mediocre CTO, or sometimes there isn't even a CTO at all. And I don't want to do those investments, right? I want to do the ones. I've done a few deals where the competition was SAP or Excel, and they get to millions in revenue, but they got there with a product that was clever, but did 3 things, and 4 years later it does 6 things. I want 4 years later doing 3,000 things. I want this exponential compounding of software functionality.
I love that. Okay, so with number 2, we have Pipedrive. Pipedrive sold for $1.5 billion in cash.
Yeah, to Vista.
Fucking get out of it. What was the revenue when it sold?
They're also doing about 100 million.
100 million also. Okay, that's super interesting. How much did you earn on Pipedrive?
The altogether was almost 10%. 5 co-founders is too many, is one learning.
Okay.
Now you can have 12, but I think 5 making decisions is too many. The other interesting thing was, they had a lot of changes, and there was a lot of CEO changes and a lot of cap table changes. That one today, it's tough. I mean, they owned a segment that now HubSpot has just taken over. And this is what happens if you get extreme product market fit. And it's interesting. When I invested in Pipedrive, was my first investment ever in 2013. And even in 2013, I remember going on, I don't know what website I was trying to learn. There were 20 like SMB CRMs that all looked the same as Pipedrive. They were all Trello clones with Kanban cards, and they all looked the same. Okay, they all look the same. Now, Pipedrive was slicker. It was faster. It was slicker. It worked. But most importantly, even though it was at $1 million when I invested, it was already breaking away. It was at double-digit growths, right? It was growing more than 100%. So it wasn't that complicated an investment at the time, right? And the product market fit remained insane, but I don't think the product has changed much in 11 years. And then HubSpot comes in, and I met the HubSpot founders early because they were wanted to get into CRM, and they knew I had invested in Pipedrive. So that's actually how I met Dharmesh at first, was talking about Pipedrive and, were there synergies with HubSpot back in the day and all that. And they decided to build themselves and a clone. And, for 2 years it was free, right? Their product wasn't even that great. And now it is the biggest source of growth at HubSpot, right? CRM is at 700 million, I think, and it's growing faster than marketing automation. So they won this thing, but they weren't able to get to that next level. And it is very interesting that HubSpot won that market in the end, right? They won that market in the end. Not that Pipedrive Vista won't make some money off of it, but so there's some timing stuff in these best by cash, right? There's timing, and that's what makes venture stressful, right? We all want to hold forever. But one lesson from this one is maybe don't hold forever. If the founders are gone, and this is the other thing I believe, Harry, and I know most VCs disagree with me, but when the founders leave, I'm pretty much out. It's not that I'm not a fan. I'm a fan. I'm going to be there, but I would like to sell when the founders leave. I would like to sell.
Always.
That's my learning. What's that?
Always?
Always, because I know everyone thinks Frank Sloopin was so great, but he left. He left when times got tougher, didn't he? He did.
He did.
You know what happened when growth finally slowed at Snowflake? He stepped down. But a founder wouldn't have stepped down. The founders never leave. You're a founder forever. So I know a lot of people like bring in professional CEOs and believe in this, and some companies need it, right? And maybe if you bring in a professional CEO and the founders are still running the company, that you have that DNA. But what I learned from Pipedrive is, you do, when the founders are not there, you lose this competitive agility when it's being run with knobs and dials, right? So that's the venture learning, which is, for now, for me, right or wrong, if the founders leave, I will liquidate my position as soon as it's significant, right? There's no point in selling early, right? It's another life lesson, right?
I've got a question for you. I don't think these PE guys are going to make money on, I'm maybe going to, but on Pipedrive. Fuck, I think it's hard. HubSpot are cannibalizing the shit out of them. Zendesk, at the buy price that Zendesk was, you think you're going to make money? Yeah, on that growth rate and that decay rate and churn rate of customers, I don't think you're going to make fucking money. You're not innovating at all on both. Sorry to say, are they going to lose that money?
Given today's multiples in today's world, yeah, I think they'll lose money on these deals, right? The question, well, there's a micro question and a macro question. The micro question is, just like LPs are coming around to giving VCs mulligans for their 2021 funds, are they going to give PE funds a partial mulligan, right? Are they going to give PE funds an okay if they do a 1x on some of these deals, right? Even together, right? I don't know if PE gets a mulligan for these bubble deals, right? Then it doesn't really matter, right? If they have to sell all these deals for 50% of what they paid, but the LPs have moved on, we'll all kind of quietly forget about it, because that's what's happening in venture. Everyone's getting a mulligan. Everyone is getting. The LPs have decided there's no point in being a critic for your 100x deals in 2021. We're going to more be a critic for your 100x AI deals in 2024. But the 2021 deals are behind us. So I don't know if they're held to the same standard. It's going to be brutal, and it also shows, I'm going to mangle the quote, but there was that thing that Bill Gurley said about how important timing is for exits, right? And how important 2021 was for exits, and Slack selling for 27 billion at $1 billion in revenue. What would Slack be worth today at $2 billion in revenue? Maybe it would be worth 12 billion, right? At twice the revenue. And so there's timing here. And when you hold on to your NVIDIA shares for 37 years, these are interesting questions. Now they're all competitors, a different
yeah, but Gong are trading it not far off that on secondary markets.
Yeah, they raised at 7 billion their last round.
I know, this is my point though, which is God, what a great exit for Salesloft, and well done to them.
Well, it's fun. It's you know what the other learning from that one is?
What?
This is a VCism that it turns out it's true. If the founders say to sell. So Kyle was sure this was 2.5 billion at the end of 2021. That was an early investment. I wasn't on the board at this point or anything, but I was on the sidelines. It was mixed whether folks wanted to sell or not. It was mixed. It seemed like everyone wanted to play. The goal in 2021 was to play another card, wasn't it? Why sell at 2.5 when 5 billion seemed easy? Right? That's where you make money in venture, is that last card. It's that last card, because that's where you get the big multiple in your fund, right? So Kyle had to push it through. He had to push the sale through. He's the kindest founder I've ever invested in. And it's a reminder that you can be kind and win. And but he pushed it through. He said, listen, this is there is no argument that this is not the right thing to do for the company. Like to get here, post dilution, post IPO, post everything, this is the thing to do. And so when founders say that, just like when the founders leave, I'd like to quietly exit my positions. When the founders say this, I've changed. When the founders say to sell, I'm no longer going to talk them out of it or even play devil's advocate. I'm just going to tell them, I'm sure you're right. I'll play a little devil's advocate if they ask me to, but if they don't ask me to, you're right. Let's do it.
What is HubSpot's Pipedrive competitor product at 700 million?
CRM.
Yeah, but what does that teach you? When you look at them getting to 700 million so fast and Pipedrive being at an amazing but much smaller 100 or 150, what does that teach you? Distribution's everything? Brand
it's
is
not even distribution helped them, but it's very interesting. If you listen to Dharmesh and Brian, they had some distribution, but remember, back in the day, it was a single product company selling to marketers. The distribution to sales professionals was very adjacent. It was attenuated at best, right? And I had a long conversation with them just on this point. I remember at SaaStr Annual when they came together and they're like, yeah, like people thought it was crazy. Like it's not the same buyer. It's not the same ICP, but here's a bunch of learnings. One of it, and this is how I met them early. Like if you have a founder-led company and and a bigger company is going to do this, like this is this was their top priority beyond marketing was to do CRM. It might have been a dumb idea because it was a different buyer. It was a different time. But they were willing to invest multi-years in a free version, a decade in doing this because they knew it was the right decision. If it's founder-led, be wary. Be wary. That's what Olivier has done at Datadog, of decimated multiple categories because it's a founder-led company. And he comes in and says, we're going to own these categories. We're going to keep owning a product after a product. Now, they don't win in everything, but that's why, a huge percent of Datadog company customers buy 8 products now. Those are the ones to be wary of in the competition. You think the big companies are slow and and disagile, but it's not always true, especially if they're founder-led. It's not always true.
You say about founders expanding their product lines there and kind of moving away from core focus and adding to it. So often founders want to do that and boards and investors say, no, don't. We need to focus and we need to make sure that we nail the core market. Sometimes they're right, sometimes they're wrong. How do you think about when's the right time to nail the core market versus when's the right time to have the founder aspiration and expand product?
Yeah, I've thought about this a lot, at least in B2B. I think it's actually fairly straightforward. It seems complicated. This is you got to be careful with a lot of knee-jerk VC advice, right? As you approach 10% market share in your core ICP, your core market, you got to expand because growth, at some level, growth slows as you cross 10% market share. Like you can't get to 200% market share. Now, here's the thing. Here's the disagreement. Now, going from 10 to 20 may happen relatively quickly. So you only see it in some of the metrics. You'll only see it in like deals taking longer to close because you already got all the easy ones, right? You may only see it in other, but I always see something as folks cross 10% in their core ICP. I always see something getting harder, and you have enough time at 10 to be implementing your second act calmly, And so that's why, and founders don't see this. This is a tiny way I try to help them. When I see this happening, I'm like, okay, let's break it down. Who's your core buyer? Well, it's restaurants in the south coast of France between 2 and 4 tables outside. Okay, great. I get why you got that. How many of them are there? 3,000. Okay, how many customers do you have? 250. Okay, guys, we actually have a risk that our growth slows in 24 months because we own this market. What are we doing? And there's the Parker Conrads that solved this problem on day 0, right? Albeit with hundreds of millions. But I find more founders these days, it sneaks up on them. They're so focused on the minutia and scaling and building that management team that they don't have that second act as they cross 10% market share. Now, it doesn't always have to be a second product. If it's at the early days, it could just be growing your ICP much broader, right? It could be going more enterprise, might just quadruple your market size right there, right? Going to another country, going to the US. So it's not always second product, but you need another act as you get to 10% market share.
Yeah.
Right.
Okay. Any other big takeaways from Pipedrive?
I'll tell you the funny one is almost all the investors that I saw in the early days, they didn't listen. They all invested, including Shaquille O'Neal and a bunch of others, all invested because they wanted to invest in the next Salesforce. And the founders kept being like, that's not us. We are a PLG freemium self-service company. We've barely ever used Salesforce. We are not building Salesforce. And everyone's investor memo, and everyone was like, we're building the next Salesforce. And that's a learning that a lot of investors create these narratives in their minds to simplify investments. And sometimes they're not even listening to the founders. They're not even listening to the founders. And maybe Pipedrive, to be a $10 billion company, maybe it had to be the next Salesforce. Right? Maybe it had to be the next Salesforce, and it's not what the founders wanted. And even once, as they transitioned out, it's not what ended up getting built, right? It stayed primarily an SMB company. So listen to if the founders have a very specific goal and it's rigid, listen to it, because that may be all they want to build.
Before we discuss a winner in NAV, can we talk about one that didn't work and a miss? And what were the big lessons from that?
My worst loss is $5 million. Okay. Then I have another one where I'm going to lose $3 million. But then my worstest loss, I realized, was a company where I made 5X that sold for $100 million right when lockdown happened. You may remember the world changed, maybe less in the UK than in the Bay Area.
But did you say it could have sold for $100 million? No,
it sold for $100 million. It should have sold for much more.
Wow.
That's not worst. I made 5X the money, but lockdown just accentuated a lot of challenges we were already seeing, right? A lot of folks panicked a bit. And what was happening with this company, my learning is, why did they sell at $100 million? Well, he was making a mistake that I see so many unicorns made the last 24 months, but was harder to make in then, is he got himself into a pickle. He hired a terrible CEO who hired 25 terrible sales reps. Terrible. We went from 5 reps and a VP of sales, who he immediately fired the CEO and brought in 20 people plus himself, and they did half the sales of the VP of sales plus 5. Okay. And not only did sales go down, but what happened to the burn rate? It obviously went way up. And so rather than deal with it, he let it go for 4 quarters, 5 quarters, 6 quarters, because he'd raised a bunch of money. And then you're just in this pickle, right? How do you get out of this pickle, this high burn rate pickle, and sold the company? But it was not much smaller than a competitor, which has since IPO'd, and today is worth. They were really pretty close, and for a while, and today is worth $20 billion. So you look at those ones where you were winning in the market, where you had competition. You're like, from a venture, what's the lesson learned? And so I don't know if that's the worst because you made money, but that's one where I wish the founder had not been so stubborn. And I see this a lot, even with, and this is I see this a lot with smart founders that are too stubborn, though, is they just stick to these bad executives and bad decisions for too long. They just stick to them for too long.
Did you say you lost $5 million on one?
Yes.
Okay. Talk to me about that one. What did you get wrong?
Well, okay, here's a really interesting, I reflected a lot on it. This is a mistake I think a lot of folks are quietly making even now, which is, and I know you wouldn't make this mistake, I don't think, Harry, although maybe as you raise bigger funds, you might. I lost it on the third check. So this is a company, what actually happened, this was my one where the signal was that the CEO misrepresented some of the financials, not Sam Bankman-Fried level or Theranos level, but just enough that it crossed the bullshit line. Just enough that it crossed the bullshit line. And I ended up still writing a third check into the company. The first check was small, right? The second check was a supporting check, right? And the third check, they just started to grow like a weed in 2021, like everybody did, right? It exploded, right, in 2021. But there were a lot of issues with the company, even as it, started growing double digits each month. And from a venture perspective, the right thing to do is just not have written the third check. We were all geniuses in 2021, and we all had extra money to invest, and it all made sense to allocate a certain amount of capital per investment. But I should have lost $1.5 million and not written that third check, or 2 million instead of 5 million.
And so for this 5 million, you doubled down when you shouldn't have doubled down, correct?
Yeah, or possibly tripled down, depending on how you look at it. That was the mistake. Yeah. So I'm agreeing with your life learnings, but and I did it intentionally, but I did it reflexively. The learning is, I think the mistake, I probably made a lot of mistakes, but I think the mistake a lot of folks I've seen in venture in my own portfolio is there's zero diligence for these checks. None for these follow-on checks, right? As long as the top line looks good, no one ever checks anything below the top line. There's no diligence, no customer calls, no nothing, right? That's the conundrum with the follow-on checks is if you treat them as seriously as the initial checks, then I think that's the right way to do it, right? But VCs don't.
Okay, well, let's just unpack that a little bit. In terms of the diligence process then that you have today, we mentioned spending time with obviously the CEO and the CTO. What else do we do? Do we do customer references? How many? How do we document them? Just walk me through the diligence process for you.
My third one is the bank account. I used to do all these customer references before when I had 3 months. 2 months at Salesloft or 3 weeks with Talkdesk. I used to leisurely get on the phone and do. And I just saw you said you did 15 in one day. I'm proud of you, Harry. But I can't do 15 in a day, and it takes me a while to do customer diligence the way I do it. So I've resequenced it in order. Right now, I assume the diligence will be tolerable, right? And I'm upfront in the timing, right? And now I'm quickly after my losses. Now, instead of doing financial diligence at the very end, right? Just to check the box before I wire the money. Now I do it in the beginning because I want to just make sure there's no shenanigans. I want my financial term, the accounting firm, the auditing firm I've worked with for over a decade to make sure that the financials and the bank statements are close enough to accurate. I want about 80, 90% accurate. I don't need it. I'm not expecting you to have a CFO or a CPA or a CFA or I'm fine if it's wrong, but what I'm looking for is bullshit. If I look at the investments I'm most stressed about and frustrated with, it's where there's any bullshit in them. The best founders don't bullshit. I don't think the best founders bullshit. I think you can build a unicorn bullshitting, but I don't think the best founders bullshit.
Do you think you have any frauds in your portfolio today?
I don't think I have heavy fraud, right? But I think there's $5 million loss when you take 12 months of revenue and you recognize it all in 1 month. That's at the edge of fraud, isn't it? That's why I like this quick bank statement check. Like, okay, just go through it and just make sure that the expenses and everything matter. It sounds silly because it doesn't really matter when you're making a seed investment, whether there's 200K in the bank or $1 million. It doesn't. But what does matter, I find, is just I don't want there to be any when we're investing faster, Harry, and we're investing broader. I just don't want any shenanigans. I just don't want it. Life is too short. I don't want any. I don't want any bullshit. I don't want any manipulated metrics. I don't want. And the problem with these bullshit artists, Harry, is they're bullshit artists for years. It'd be one thing if it was one and done, if they just bullshit you in the financing, but then every investor update's bullshit and every board meeting is bullshit. It's just an endless stream of bullshit and you can't it's not worth it.
I get you. My challenge is in a world where other people don't do it and move so fast, when you're the one being like, hey, can I have your bank statements?
Yeah.
Anna's like, fuck off, mate. And
I don't think so. I think it's if a founder can get you something in 5 minutes, by just logging in online and shooting it to you, I think that's a lower lift than other things. I feel guilty too early about asking for customer references if I'm not like 90% sure I want to invest. I still feel guilty about that. I still feel guilty about burning. And the VCs don't care, but I know having been I felt uncomfortable as a founder. I only raised a couple times burning those. You want to talk to Dell and Comcast and LinkedIn again, the third guy that then doesn't invest. It's just like, so I try to actually do things that are quick. And then I view those customer calls as a real ask, as a favor and for real. And so I'm hoping they mostly confirm what I believe to be true, right? I'm not looking for a customer call to turn a frown upside down. I'm not looking to take a marginal investment. This is, I think, what VCs used to do in the old days is they'd hope. Right. I'm looking only for confirmation with customers. If you're at $1 million growing 10% a month and your churn is low, I'm going to assume your customers are mostly happy and I'm going to gripe about a bunch of things too. Right.
Okay. So we're at $1 million. What monthly growth rate is good enough to really pique your interest? And what monthly churn rate is like acceptable?
Yeah, this is if the mistakes, it's painful to say it because you want to believe it otherwise. When I've let the growth bar go down just a little bit, I always regretted it now.
What is that? Is that from 15?
It's got to be, at the end of the day, the best investments still, and this is brutal, the best investments go 1 to 10 million in 5 quarters or less, the very best ones. The one, you can't IPO unless you triple, double. You can't IPO unless you triple, double. This is now, and we knew, when I started investing, I remember putting it on the whiteboard, trying to figure this out. And I invested in Pipedrive and I'm like, okay, they're growing 8% a month at just over $1 million in revenue. And I'm like, and I was asking the other VCs I was working with, like, is this good enough? I actually didn't, this was a long time ago in SaaS. I didn't know, no one actually knew, but I'm like, okay, 8% is my new bar at $1 million. It's got to be 8% a month because I was growing 6%. So I'm like, okay, it's better than me. And two, I don't see how they'll ever get to 100 million before I'm in a retirement home if we're not hitting these numbers. And that 8% ultimately, we really want 10, which is where you fall out of your chair, is when you see that double digit growth at single digit millions, right? That's when you fall out of your chair. But this basic VC math of triple, double, as much as it annoys founders and they say, well, it's harder now. And I don't have enough. How could I do triple, Harry? I only raised 6 million, or I can't raise a Series G or Series Q. The IPO markets don't care. They actually don't care whether you raised nothing, right? In primary like Atlassian, or whether you raised a crap load like Rubrik, or whether you raised almost nothing like Klaviyo and then a bunch and then burn nothing. The IPO markets don't care. They care if you're efficient the week you IPO, like the 2 quarters. They don't care about the past, do they? You've got to triple, double. You got to do it.
Has expectation on revenue trajectory changed in the wake of Deal scaling to a monstrous 500 or 600 million ARR where they are today, in the wake of Wiz being a monstrous whatever they are today, 500 million in ARR, in crazy times? Has what we expected in terms of revenue scaling changed?
For venture, I think people are full of S. I think everyone wants a Wiz, right? Now we know it's possible. Right now we know it's possible, that a Wiz is possible. But the truth is, if you're in the zone today, if your growth is good enough, what has happened is, like, there was, in 2021, if we had a pyramid, this many folks could all get funded, right? For, I don't know, half the pyramid could get funded because everyone was growing to triple digit rates, right? Now it's a much smaller segment of the startup community growing at triple digits. So actually what I'm seeing is they're flooded with even more capital. They're flooded with even more capital, the outliers, because there aren't enough of them. There's just as much capital. Almost as much capital as there was. Maybe there's less. There's almost as much chasing fewer and fewer folks that can grow at triple digit rates. The way I'm seeing in my personal portfolio is, and this is so different than 2020, is talking about pro rata. Anyone in my portfolio that is growing quickly, the insiders flood it with capital. Flood it with capital in a way I've never seen in my whole career. Everyone used to be risk averse, and then they wanted Tiger to do it, and they wanted SoftBank to do it. Now the big funds, the $10 billion funds, they just want to, they don't want to share to leave the cap table.
In any cases, did it turn out for the better for the company?
To what? To take all this insider money?
Yeah, to get flooded with cash.
No, it's a complete negative. Because they do less work and they have a different bar, right? Because if you're managing 10 billion and you've got a $5 million stake or $10 million, and that company it's just in the top decile of your portfolio. It's not Wiz, but it's in your top decile. What are you going to do with the other 9 billion you haven't deployed? You're going to put it into that company. And you're going to, and as you see that other people want to do it, you're going to get, your elbows are going to get sharper. And then you're going to realize you got to do it with secondary. And then you realize, you know what, the deal's only worth 200, but if I offer 300, like, I wouldn't do it for a new investment at 300, Harry, but I already invested at 20. So what's the difference on a blended basis? Like, it's like, I'm going to make money, aren't I? Because this is a $1 billion company. This is going to be a $3 billion company. And so it inflates valuations, and it puts, companies are getting overfunded at inflated valuations by insiders today. I see it left and right.
I agree with you. I also see people doing structured rounds as a way of preventing the world from knowing how bad a company is, or flat rounds just to prevent the world from knowing how bad a company is, or from realistically marking it differently in their books. I
only have a certain narrow bit of experience. I'm sure there's examples. There's nothing wrong. Like, so many companies had a bridge round, right? A true bridge round. Like, you just get it wrong. I had one as a founder. I needed an extra 500K. But these sort of taking a company that's struggling and putting tons of money in through safes or debt or whatever, how many of these have turned around and been $10 billion companies? How many of the leaders in cloud had like a year and a half or 2 years of 8% growth, and then investors put another 60 million with safes and they turned it around and people made money? I mean, I feel like they should be written off.
What happens to these kind of zombie public companies, Jason? And it sounds awful, so I'm going to just get in so much trouble for this. But like your Dropbox, your Box, your Twilios, with low growth, kind of unexciting roadmaps, kind of single digit market caps. What happens to them? Are they kind of like zombie public companies?
I don't think so. I would have thought that if you asked me 18 months ago or even 12 months ago. Two things. First of all, like, I'll take a very recent example, like Model N, which was growing like nothing. Okay. It's a public company in revenue optimization for pharma. Okay. It had the problem is it never expanded its niche. Okay. It's kind of like contract revenue management for pharma. and it grew pretty nicely. And now it's not growing at all. It just got bought out by Vista, our friends at Vista again, for $1.25 billion. So is that like a great outcome or something? I don't know. But like, first of all of these companies, as things swing back even a little bit, they're all targets for PE, right? They're all whether it's Zendesk before at 10 billion or Model N. This is a good price for Model N.
What does PE expect to do? Do they expect to just like margin efficiency the shit out of it, cut all excess, and then reinvigorate growth? I mean, if they're the ones to reinvigorate growth, they must be pretty optimistic.
I don't know. Certainly you can see, we started the conversation with Salesloft. I mean, Vista combined them with Drift, right? So I don't know what Drift was doing. It was doing 100 million when they got acquired. Even if they're struggled a bit, let's assume you bolt on another 100 million. I know we make fun of these bolt-on combination things, but I mean, maybe they work. Like, it doesn't have to be perfect, right? Maybe there's a lot of financial engineering. I don't know for sure. You could talk to them. I don't think there's any dummies here. I don't think there's any dummies. And the other point, so I don't know the answer. The other point I'll say, you talk about zombies, but some of these zombies are approaching 40% operating margins. And look, it's not fun. I don't think it's fun to be running Dropbox today. Okay. I don't think it's fun. I don't think it's anything like when Drew started, but they're approaching 40% margins. And if they decide they want to run this as a cash engine for a while and then slowly reignite growth, it's so profitable at scale. I don't know. I mean, Squarespace just went private at 7.5 billion, right? At 20% growth. It was in the middle. Will they come back out at 15? I don't know. It's easy to be cynical about this stuff going to our early conversation. Like, I didn't believe you could make venture money in 2013. I'm starting to get nervous again in 2024. But I think there's logic to this, and it doesn't take much multiple expansion in the public markets. It doesn't take much growth reflation, right, for these deals all of a sudden to be great deals. If multiples go from 6x to 8x and everyone, what's clear, if you look at what Yamini said from HubSpot just a couple weeks ago for this quarter, she said it is not any easier. Even though they're growing 23% at 2.5 billion, she said, listen, it was briefly easier in December. Q1 was brutal. It is as hard as it's ever been. Like, we sell to small businesses and we got to sell to the CFO and do demos. We didn't used to have to do demos. Like, it's hard out there, even at their rate. But when it does turn, like, all these deals may be decent deals. Like, they may be 20%. That's what you got to do, is 20% net IRR, right? Is the goal here, right? They may be decent deals. And I just remember, I know I'm doing it a while, but when things were really crappy in the 2016 downturn, I might be getting my timing off, and LinkedIn panicked and sold to Microsoft cheap, right? And then Marketo sold to Vista for $1 billion, and everyone said they never could make money, right? And they ended up selling for $4.5 billion and all of that. It took some market reflation from that brief downturn. And now we've been in this. If you're in a segment of SaaS that's in a downturn, we're going into the third year. 2016 was 1 year. This is 3 years, so it's tough. But if you make the right bets and things just go up 20%, you can make a lot. That's a lot of leverage. That's a lot of leverage. And multiples go up 20% and growth grows up 20% more. You can make a lot of money. You can make a lot of money.
I get you. There are two other elements there which I want to discuss. You can see my hands are just getting destroyed.
I love your new note taking. I'm not familiar with this.
Very, very advanced. Number one was churn rate.
Yes.
What is an acceptable versus unacceptable level of churn rate for $1 million ARR company? And how does that differ between SMB and enterprise?
It's tough. Well, look, let's break it up into two. For enterprise, I think if your NRR isn't north of 110% by that point, don't invest. You have to have triple digit NRR. It's just the way it works. It's hard enough. It's even harder to break into the enterprise than the SMB in some ways, just because sales cycles are longer and it's more complicated. If you've somehow gotten to $1 million in revenue, you've solved a niche but big problem in the enterprise, right? They're going to buy more of it from you if you solve more of their problems. I've never not seen triple digit NRR at that scale. I've never not seen it. Never in my career. My own experience as a founder or any company I've invested in, it's always triple digits in the enterprise. Something's fundamentally broken if it's not triple digits at $1 million. Now, SMB is the tougher one. And I know that, sometimes when Dharmesh and Brian talk about HubSpot in the early days, they're a little, I know they're, and Dharmesh is an engineer, I hear a little bit of confusion on what the monthly churn was. Was it 3 or 4% or 7%? 3 or 4% is what we see with a lot of very small businesses. Will churn 3 or 4%. Credit cards expire, they go out of business, they change things. If HubSpot really was 7 to 8% and then got to 100% NRR, that's 110% at the peak. That's that's mighty impressive. But if the churn is anything more than 3 or 4% a month, it's not even software anymore. It's some sort of consumer-like thing that does not have recurring revenue. There's a fundamental question, Harry, which is, do we even have recurring revenue here for companies, right? And at the end of the day, you've got to get to 100%, right? Dharmesh and Brian agree. Everyone agrees you've got to get to 100. The question for SMBs is, can you tolerate 3 to 4% a month churn, which is endemic for small businesses for a couple of years? That's the venture question. And I've passed 100%. If you want to tie it together, I have no regrets here. I have passed on every single company that had, for their segment, abnormally high churn, 100%. I've gone back to so many founders that were at $1 million with 7 to 8% churn. I'm like, you have something, but it ain't SaaS. It's not SaaS, right? It may be something that may be consumer. Maybe that works in a bento box to your house company, but it's not. Our whole fundamental model in software is like, not, it all breaks if you don't have 100% retention.
I'm looking at this literary growth model for this company now. 2.6% churn rate in August. Okay.
That's what I would expect. It's SMB.
And then in December, it's a 5.6.
That's what I would expect. And that's the risk. And that's the risk.
And so how do we think about that when there's a variation that is doubling or halving, but is highly volatile? It's not really got any form of predictability where I can hang my hat on it and go, well, it's 3.
Well, I do think a couple things. First of all, I do think that even for startups, an L4M model is great. Take the last 4 months and average almost any metric. Even as you're approaching $1 million, I find it highly predictive. I find if you take the last 4 months of growth and average it, that's going to be your growth the next 8 to 9 months. I find if you take the churn, that's going to be just take the last 4 months and average it. I find it incredibly predictive and burn, churn, and growth. It's highly predictive. And that's why, when I started investing, I do love their model. I would take their historicals and I would just build my own. Doing an L4M model was always right. It's always been right doing an L4M model. So that churn is high that you're describing, but for the industry you're talking about, and there is a difference between small businesses and very small businesses. Very small businesses do churn 3 to 4% a month. They do. And you've got 2 choices in that environment. You can either do what like Ben Chestnut did at MailChimp and just be hyper efficient and say it is what it is. If you're profitable, if your CAC is 0, you can survive a 4% a month churn if your CAC is 0, right? If you have a sales-led model, it is unsustainable. It is unsustainable in a sales-led model. That's the line. And so can you bet that a Mark Roberge will come in like at HubSpot and help you go mid SMB and figure it out? The best founders will figure it out, Harry. They will figure it out. But anyone but the best gets stuck in this 3 to 4 to 5% churn environment, and they never dig themselves out. And even worse, sometimes they obscure it with capital. Here's where VCs can make it worse. They obscure it with capital. Because the other thing that happened with SMBs is actually you can grow faster in the early days in enterprise because you acquire the customers in a week or a day instead of in a year. So sometimes the top line growth rate is faster with SMB in the early days, and it can obscure that churn. That's the ones I think you either have to pass on or truly believe the founders have a strategy to getting to that 100% NRR.
What are your lessons from that observation?
That a lot of founders talk about getting that first. The deals I regret or the worst deals, the one that was only 5x for 100 million. We also never fully solved the SMB churn there. We brute forced it with capital, right? It was very SMB. And it had like 2% churn a month. And when the team was efficient and we were burning 100K a month, it was no big deal. Like it really, at some level, there's always time, right, to go up market. The question is there enough time and is there a plan? And it's tough. And it was tough at HubSpot and it was very tough at Toast. If you read Toast, it was brutal for them to get to 100% NRR. And the truth is, here's the other truth, Harry, is one, in some ways, you probably have to be better at SMB than enterprise because the margin for error is lower. Because, you sign an enterprise 3-year deal, and they don't even deploy for a year because there's business process change. You get like a whole nother year to fix it. And then, you can work on the renewal in year 3. These SMBs, the smallest ones are brutal. Like they'll look at their credit card statement and they'll cancel everything the day that the 15th or the 30th of the month that doesn't make the money. They'll cancel everything. It's brutal. And for the best founders, it makes you even better. And that's actually why I think the best software in the world are the Canvas and the Squarespaces, right? Even if maybe Canva has better metrics than Squarespace, but they have to be great or I'm just going to churn tomorrow. I'm just going to churn tomorrow. And it's almost impossible to churn out of most enterprise products. It's almost impossible, right? So SMB software has to be better. It has to be self-serve. It has to be PLG. It's not a choice. It's a requirement. And do you believe they'll get to 100%? What's their strategy? And if they don't, if the burn is low, I would take the risk. If the burn is high, I would assume the burn will increase linearly with that churn because it's just going to suck up more and more capital.
Don't laugh. What's high burn as a percent of revenue? Like if you're looking at a company that's $1 million in ARR that's doing largely SMB, what would be like an acceptable burn?
It's funny. There's the burn ratio, right? That David Sachs popularized. And I've watched different companies. I don't know how often you get in your investor updates. I probably get half my investor updates get the burn ratio. Okay. And then I started to see its flaw. The burn ratio, David Sachs is basically one or less is really efficient, right? If you burn less than your revenue, your bookings, it's super efficient. That's great if you're clear the next round's coming in and you have like 120% NRR and 80% margins. If you're not clear the next round's coming in, your NRR is SMB, so it's 60% or 70%, and maybe your gross margins are lower if you have a hardware component or other COGS. Your burn ratio may need to be much shorter. Because when you look at our friends in B2C, right, they talk about going profitable on a customer in 60 days, 90 days, 30 days. We had Jacob from RevenueCat you should do it sometimes. We had him do our little workshop Wednesday. And, I think their churn rate, they have 10,000, consumer SaaS companies on their platform, right? I think that they have a 60% annual churn rate. He's like, our customers have to go profitable in like 40 days. That's the B2C world that you and I are less familiar with. But if you're going to do very small business SaaS, you start to overlap B2C a little bit, don't you? There's an overlap here, and the last point I'll make is the big danger you can make, and this is why that company ended up having a mediocre outcome. You can't put enterprise or mid-market people into these SMB models. Just the toolkit, the type of people they hire, the way they spend in marketing, the customer lifetime, none of their metric, it just doesn't work. It doesn't work if you come out of ServiceNow where the average customer lasts 118 years and GRR is 99%. At ServiceNow, the GRR is 99. They keep 99% of their customers over 3 years. You can't put that person in. Forget about the other issue. You just can't put that person into an SMB environment. They don't even know what to do.
We were speaking about revenues. I just want 2 questions on revenue. One, do you ever have it where they're not actually presenting ambitious enough revenues?
I think it's almost certainly a pass, but if you think the founders are great, but here's where you have to check yourself. If you truly think the founder, like your job, I think everyone in life has to pass a 20-minute test. By minute 20 of the meeting, do you think this founder is so great that you have to invest? If they pass the 20-minute test, but they have a crazy metric, just share it with them. Just say, listen, Harry, I love everything I've heard today. I just want to let you, like 8 million. We're at 6 today. So 8 million in 2025 seems a little modest. And maybe he'll laugh. He'll be like, okay, I've never raised money before, Harry. I want to do 60, but I thought if I put 60 in, I read this thing on Reddit. It said, don't do that. Every once in a while with a first time founder, they get bad, everyone gets bad advice. So you got to, if you love them, give them a chance to self-correct on that mistake.
Okay. Second question on the revenue and kind of growth assumptions. In a lot of AI tools today, especially the PLG AI tools, we mentioned some of the sales rep productivity AI tools.
Yeah.
You mentioned OpusClip. The revenue growth is just like, and my question to you is, like, how do you think about that? And how do we know experimental budgets versus sustainable budgets and what you think is real revenue versus AI hype cycle revenue?
I don't think we know. And I think it's fine not to know. I think that's called venture. I think we invest in things that are exploding. And so I think if we're trying to overanalyze some of these AI explosions, we're missing the fact that we can make 20 investments per fund. I think the bigger issue is when the burn rates are vast. Then we're making that's a bet that it's just a crazy bet. It's one thing if you go from 1 to 12 in a year and you're cash flow positive like Opus, that's okay. If you go from 1 to 12 in a year and you're burning 50 million of some big fund's money, that might be a great investment like an open API, but that's a kind of bet I don't know how to make. I don't know how to do that. It needs so much capital. Do you just throw a chip in and walk out the door and tell them, let me know if you need a tweet or to be on the podcast? I'm not sure what you do if they're going to burn 50, because we haven't seen some of these AI companies. We haven't seen the way we invest. We haven't seen these types of burn rates either. Even when we've seen some that burned a lot, like a Rippling or something, it was very intentional. It was like, here, Parker, here's why. It was, decent in the early, then it's really high. But, if they're coming up on 400 million and there's a very specific reason why, and there's a plan and it's pretty consistent with the plan, it makes sense. This, I know costs are coming down, but just these massive, we don't know. So I don't have the answer, but you got to, if the founders are great and they have an answer, you got to make you got to make the bet. If they're great, you got to make the bet.
Listen, I do agree. I do think the deal has to be right. Like, you can have a great founder, but if like you hate a lot about it and it's 150 million price, there is a line where like a great founder but a bad deal, you don't do the deal, I think. I
think the other hubris that a whole generation of folks on 20 VC and otherwise we're all going to slowly regret over the next decade, and it's a tough one to solve, is just these low ownership stakes. Who was it? Was it Silver Lake that just said they regret every deal they did in 2021 that was small? Didn't they just say that?
Yeah, they did.
Yeah. It's just like, okay, like we're only going to make any money on our big positions. We regret everything. And the problem isn't that this AI deal's at 150 million pre in the seed round. I mean, that sucks. But if you have a $50 million seed, even $100 million seed fund, how much can you put into it without creating systemic risk in your fund? Founders don't get this, nor should they. But this is why I actually, Harry, believe that a lot of seed investing is systemically broken today. Because let's just do the math. When I started, a typical, I did Pipedrive at 16 at $1 million in revenue. Okay. So now your typical YC deal is at 25, right? And you can't buy much, right? So even if you could, like if you want to, so you got to do a $3 or $4 million seed check and you have a $50 million fund. How does the math work? You either have to take systemic risk, right, and do like 6 investments or 8 investments, or you have to buy tiny stakes, right? Or you have to find pre-seed stuff, right?
Or you have $100 million funds and you write.
Even 100's barely enough at a $25 million to own a true 10%, or 12%, 12% because you're going to get diluted. So you need to write a $3 million check pre-revenue at 10K MRR, 2K MRR. And I think everyone that complains about YC is missing the point that it's not for them. YC doesn't owe it to anybody to create rounds that make certain VC funds happy. I mean, it's okay. It's okay. It's a feature, not, I hate this expression, but it's a feature, not a bug. How many folks are there per batch at YC now?
No,
150. I mean, it's smaller than it was at the peak. It's 150, right? So Gary and team's job is to get 140 of them funded most as quickly and as possible. And the next week, they're on to the next batch. Okay. This is not getting just 1 or 2 funded, because even if it's Stripe, you don't know for sure, right? So the most efficient way with their brand is to have everyone sell up these really slices, create a lot of FOMO, and get it done. And it doesn't make sense to accommodate different structures of seed funds. It's a bad business model for them to make folks like you and me happy.
No, listen, I do get you. Okay,
I have no criticism at all. They have a very effective, it's just, it only works for them. It doesn't work for anybody else. It doesn't even work for EF or certainly anybody else. It only works for them.
So you've got RevenueCat and you have Talkdesk. We only have time for one more. Which one do you have more learnings from, and what are the biggest learnings from them? RevenueCat's
a fun one. I'm usually not the first investor, like literally the first dollar in the door. I'm usually the first institutional investor. This is the first time I've been the first investor at like $30 a month in revenue. I misunderstood. I confused their basically their GMV with their ARR. I got it wrong. So I thought they were doing like $10,000 a month in MRR, but they were managing $10,000 a month in subscriptions and making like $30. So I took a little more risk than I usually did. That was an easy risk to take because the co-founders already knew the space cold.
What was the price and what check did you do?
The first check was for about 10%, and it was pre-YC. So I think it was 7 or 8 million pre, but that would be 25 today, right?
Yeah.
That was in 2018.
Okay.
That's a tough structural issue, right? And it was before demo day and all that kind of stuff. And they did only have $30 a month in revenue. So maybe it was a good price. But today they would just wait and get 25.
So what are the big lessons from that?
When you have founders that are truly committed to a multi-decade journey and know a space cold, maybe that's the most important thing of all, right? So RevenueCat is on 30% of all US mobile devices managing subscriptions. And so that they've crushed. Developers love them. The product is great. Have they been too slow to develop the sales-led side of the business? Yes. I think Jacob and Miguel would admit that they're a little slow to go. They lean too much onto the PLG, too much onto the brand. but it's okay. They're at many tens of millions of revenue. They can do more there today. They've just closed their first $1 million deal. Okay. Maybe they could have done it a year earlier, but it doesn't really matter at some level. And so there are times, what's fun about a company like RevenueCat is there are times when a company or sometimes an executive comes into their own, right? Not everyone can see it. And now everyone can see that this is like the right team for the right problem at the right time. And just back them. I never had 1 second of lack of, as you probably, we've chatted just for a few times about this company of yours for fun. I've never had 1 second where I doubted the team, right? I questioned them a few times on different things. Never 1 second, because they understood a problem and were committed to it for 20 years, right? And don't want to get acquired and have a plan to IPO, and for all the right reasons. And maybe that's a rambly answer to the question, but those are the investments where I just don't think you can lose. And when my losses, to tie this all into the theme, my losses are when the founders weren't that way. This $5 million loss I had, they were woe is me. They're like, I tried really hard. This company started at the same time as RevenueCat. And for a while, they were growing just as quickly. And then they're like, it got so hard. And like, I had churn and I lost my customers. And then this $5 million company, one day they came into work and they fired their entire sales and marketing team. With $15 million in the bank, they fired everyone, just like Elon. But Elon's a better founder, fired a supercharger team. He came and told nobody. And because growth got harder, they fired every single person in sales and marketing. So my mistake of 2021, when everything was great, was moving, following somebody else. It was a waste. It was just a waste of energy. That's the main lesson. The slightly second lesson, which you probably agree with, is like, there's no good deals. If a deal seems good, don't do it.
I agree with you. I've definitely made the mistake before. It's like, a good deal does not make a great investment.
And the funny thing is, and also that was the last deal of that fund, right? So there's also some micro learnings about managing the end of the fund, because, I've never thought I was that good an investor, but everyone was kind of a genius in 2020. And I'm like, well, you can't lose money. So I might as well make some extra money in the fund, because we'll be so far into carry. Every extra dollar is just profit. It's kind of like recycling, right? If you can recycle just right, and this is the classic argument for recycling. Hey, maybe you'll only make 3x on your recycled investment, but if you can invest another 10 million out of your fund and 3x it, that's 20 extra million to the LPs and 4 to 6 extra million to the GPs. You can't lose. So this was an end of fund thinking, and I will never approach an end of fund investment treating it any differently than a start of fund investment. I will never do that again.
Any other lessons? You mentioned the micro learnings on end of fund investments. Any others there?
The only lesson that's actionable is, we talked about the company where we exited at 100 million during lockdown, right? I should have recycled all that money instead of distribute it. It was impactful to a seed fund, right? Because it was a significant return. But it was early in the life cycle of the fund. And now I wish I had those tens of millions to put into the portfolio. I think I will learn how recycling really works just after I retire from investing. I don't think I'll truly understand it. I get it, but like, there's so much, you have to manage so many funds, so much money to get it right. But just recycle everything, I think, is the learning, right? And that's a related lesson. I just wish I had those extra $20 million to put into that portfolio today, because that's another way to get an extra X out of the fund.
Your investors say you don't invest fast enough.
Yes.
So
they're correct.
Do you worry about that?
I do worry about it. I do worry about it. I don't think I do like lots of investing, but I don't know that there are downsides to not working for other people, right? Like you and I aren't. There are downsides to it. And there's other pieces. So it's a great question. I do worry about it. I do think I need to invest more quickly. I feel like I've made enough investments that the financial returns from the existing portfolio are going to be good enough. Like I think I will achieve my investing goals from the investments I've made in 10 years. But I would like to play 2 more cards. I'd like to do 2 more funds. I'd like to have 6 more big winners. And that would be enough, but I'd like to have 6 more fund returners. Okay,
we're going to do a quick fire round, my friend. Does that sound okay?
Yeah.
Who's the most underrated SaaS CEO today?
When we talked about SMBs, I think when ServiceTitan does IPO soon, I think we're going to see that Era is one of the most underrated folks. Coming out of Pasadena, doing it his own way, selling to plumbers and folks, always committed to this mission, right? I think we're going to see that this is one of those. I think him and Andrew from Klaviyo were just missed because they're out of the circle. Klaviyo was missed because it didn't really raise or do other things. Maybe they're neck and neck. I mean, if you're outside of the Shopify ecosystem, you're like, what the heck's Klaviyo? They IPO'd. If you're in the Shopify, like if you have any investments in it, I mean, Andrew and Klaviyo are like God level, coming up on $1 billion, right? Dominating this thing, kicked MailChimp out of Shopify on $1 billion in revenue. They will soon be doing more marketing revenue than HubSpot. They will be doing more SaaS revenue than Shopify in a couple of years. This is a force of nature. And there's been a little bit of grumblings when they raised prices this year, but I would say until recently, I couldn't even meet anyone on the planet Earth that didn't love this product, right? That is next level stuff, isn't it?
Market cap today is $6.5 billion.
And I think he started at 23 or something like that too.
It's 24 today. 24.
Yeah, I think I think that is one of the reasons I have some malaise and worry in venture. It should be 10, 11, 12 in my mind. There's not much better than Klaviyo. There's not much better than Klaviyo out there. You could give it a discount for having a platform risk, but based on what I follow the company pretty closely because of Gorgeous, I don't think anyone gives it a discount for platform risk. This is why almost every SaaS company is overpriced in the venture markets because of Klaviyo. If Klaviyo was worth 20 billion, then all these deals we're doing make sense. I think I'm hopeful that almost everything in SaaS is undervalued. There are folks where sometimes I wonder why a Klaviyo is trading at, what are we coming up on $1 billion? So we're trading at basically 6x ARR, right? Sometimes I wonder why an Atlassian, which is an iconic company, could never say anything but positive about Atlassian. Sometimes I wonder why it's trading at twice the revenue. Why is that a 12x company? Sometimes I don't know, right? It's growing 20%, which is great, but it's not 40%. It has great cash flow. Some of these just multiple dislocations. I'm not a smart enough public guy to get, but exactly why that's true, I don't know. The Klaviyo to Atlassian gap in multiples remains a mystery to me.
Tell me, what happens to Anaplan? Like, respectfully, terrible product, getting eaten alive by Pigment, bought by PE, fuck all innovation. Like, what happens there?
I don't know what happens to these PE companies that invest less after they do. I don't know. I mean, we are, at our little team at SaaStr, we are accidentally stuck on Marketo. We would be on HubSpot if we could be. We have huge data issues for migration, but we're stuck on Marketo. And so, but it's kind of fun as a case study. I mean, literally, I don't think they've launched a feature in 6 years or whatever. I guess it's under PE and then Adobe. Nothing. It's the same clunky app. A lot of people still swear by it because it is powerful in the enterprise, right? What happens when companies stop innovating? I don't know. I guess the meta question is, can they grow in the teens? This is the Dropbox question. Can you grow in the teens, right? And sure, maybe Pigment's on fire, but I can't segment the market. Maybe Anaplan is stronger in the true enterprise, for example, or maybe they're impossible to rip out. It could be the case in the place. I don't know. I think if you can grow in the teens, you're still going to hit the rule of 40. I think if we look at our public companies, you still have a lot of enterprise value if you hit the rule of 40. There's no point in venture, but in the public markets, there's still a point. So maybe that's the bullish version, is that these companies have, even though we can be critical because we're so focused on the upstarts, they may have a decade to run if the growth is in the teens. Even 15% growth over a decade, that plus maybe 35% margins, those compound to a lot. 15% a year is better than most VC funds make. They're in the single digits now.
What's the biggest thing about the world of LPs that you wish you'd known when you started?
Listen, I don't have any great learnings. I basically have two anchors, and they've been the same my whole career. I have Horsley and Transpose. Together with their affiliates and friends, people would say it's a bad idea. I think they're 80% of all the funds I've done. Okay. People would say that's a bad idea. It's too concentrated. But everything I've asked for, direct, indirect, follow on, whatever, they've done it one way or the other. So for me, for my gig, it's worked out pretty well. So what's my learning from that may be radically different than like 99% of people. My learning is, but maybe not. If you can find a couple LPs, ideally 4 or 5 that truly believe in you, right? And you don't put up too many mulligans, and you deliver with some regularity, it's a gift because you can kind of do your thing. Even if you're a little criticized for investing slowly, like we talked about, you can kind of do your thing. And I've worked in environments where it was very transactional with LPs, right? And I've worked in environments where you're more supportive. It is better to be more supportive. And maybe it's better to not be aggro. Maybe it's better to leave a few nickels on the table. Maybe it's better to go the extra yard. I don't have the answers, but let me put it differently. I've been able to work with my LPs like I worked with my VCs, which is a good framework for me, rather than to work with them, which maybe another kind of mistake, rather than work like, everyone's just a number on a sheet, right?
Final one for you. You can invest in a seed fund, a Series A fund, and a growth fund. Which one do you put money into for each?
Well, first, my advice to everyone out there that like emails me, hey, can I invest in SaaStr fund? Don't put money into any of them, is my advice to individuals. Because I don't even think everyone's full of shit. I think even making if you do a seed fund and you make 3x net after 16 years as an individual, that's put the money into S&P 500, put it into VTI. It's not worth the extra gains for the illiquidity, and people don't they don't write a large enough check into funds as individuals, right? If you put half your net worth into it, I would get it. But if you're putting 100 grand or 50 grand and that triples to 150 grand after 16 years and it's illiquid, it ain't worth it.
If I said to you, here's pension fund, you are the CIO, go put money in a seed fund, a Series A fund, and a growth fund, and this is absolute returns focused. I want money back.
The little bit I know, I've been doing this just long enough that I see all these funds decaying. I see partners leaving. I see old playbooks not working. I see folks struggling. I even see pretty good investors investing more slowly. You see folks quietly stepping back, or they're not investing themselves. Their teams are doing all the investments now. So I have the same issue that I think is the existential challenge for LPs is you're looking backwards. You're looking backwards. And a lot of these funds that we all look up to, a lot of those managers aren't even active anymore, or they're not fully active, right? Or they're not as active. And so I don't know. I don't, and a lot of folks' returns, you have access to 1,000 times more data. A lot of it is not as impressive as you might think. Not that you need me, but the handful of times I've been able to help you, I've recommended you. I'm saying I can't predict the future perfectly, but here's someone that has the right drive, that has enough of a track record to put together. I think you got to make the Harry Stebbings type bets, because I don't know how to make the rest. I don't know how to make the rest when look at like OpenView, right? So made so much money on Datadog. How much money did they make on Datadog? They owned almost 20% of Datadog.
I mean, what, 3-4 billion?
So and then you're done. And then one guy owns the whole fund, right? So like what? Even that shows how like people don't misunderstand what's going on.
Do you know what happened there? Though there was something funky there.
My general assumption in all these situations is the most logical thing happened, which is look, one problem. If you have one guy owning the management company and like 50 or 80% of the carry, and you have a Datadog exit, and then it gets harder. Everything gets harder. Why would you keep doing it? I mean, you got to really love it. So like if they made $4 or $5 billion off a couple $100 million fund, let's have some fun for the audience. We should do the math better. But let's say they made $3 billion in carry. Okay. And let's say it was just 20%. So that's $600 million to the partners, but the one guy got 60%. So let's say he made 350, 400 million. And now you're in your new fund and it's hard, Harry. We're sitting at 1x. I got to hustle, and my valuations suck. Datadog, every investor that got in a Datadog until the late one got in cheap, right? I mean, we did a fun one together with IA Ventures and the others. I think they invested like $4 or $5 million in Datadog in the early days, right? OpenView, I think, did it in the teens, right? Now they're like the next Datadog's at 400 pre, and I'm like, would you? And okay, and you're running the fund. And you're like, okay, listen, I got to sign up for 14 years, and I'm going to make like nothing in carry or a couple million. I made 300 million off Datadog. What would you do if you didn't see 3 billion coming? Like you'd hang up your hat. I'm assuming that's the answer. I could be wrong. No offense to anybody, but I just think my limited understanding is they made so much. They have some good investments, but there's no way they're going to make 400 million as GPs off Calendly. Is great. I mean, it's such an iconic company, but owning 8% of Calendly at a 3 billion entry price is not the same as owning 20% of Datadog at 16 million entry price, is it?
I love that.
It's so much work, right? So Calendly, we all love Calendly. Let's say IPO's at 6 billion and they invested 60 million. So maybe it probably doesn't return the fund, does it?
That's so
you blow your brains out, right? And I think you ask why I invest more slowly. There's a lot of reasons, but one is, listen, I don't want smaller ownership stakes. I don't want single digit ownership stakes. I don't want anything that doesn't return the fund for real, not for fake. Not to raise the next fund, right? You realize like there's a lot of fake bravado on Twitter, and a lot of folks making personally very little money on very high profile investments, right? So that's my May not be what happened at OpenView, but when you have one of these outlier events, right? Even the guys at Emergence who I love, you know, they had a gentle transition when they made so much money at Emergence. Between Bill, Viva, they own 30% of Viva and they held it, right? So let's have some fun. I'm not going to look it up, but what Viva's worth, what, 35 billion today?
Yep. 100%.
I know they kept it at the fund level until 8 figures. So let's say they had 25% carry and distributed at 20 billion. So the partners, okay, let's say they had 6 billion. The partners had $1 billion to divide up between themselves in that fund. Plus they had Yammer, plus they had Bill. This was an epic fund, this fund. They had little old Echo sign, didn't even get above the line. You know, and so how would you keep going? I mean, Gordon's still there. It's a great fund, right? But you know, when you have those moments in time, I mean, it's so much money. I remember I was on a board with John Doerr when I started investing, and I asked him why he kept doing it. And the only thing I saw was he still had the sparkle in his eye, you know, back then. This was 2014, but he still had the sparkle. But if you've made that much money and the sparkle's gone, I mean, this dealing with this bullshit is not worth it.
I love that. Listen, Jason, I've loved doing this. Thank you so much, as always. This has been fantastic, and you are my hero, my man. I look forward to London.
It's going to be fun. It'll be good.